Hi, everyone. Sorry for that. We're having a little technical difficulties. Welcome to today's Stambaugh Ness webinar, Construction and Revenue Recognition, What You Need to Know, presented by Steve Snyder, who is a principal in our AEC industry group here at Stambaugh Ness. Before I pass it over to Steve, just a few housekeeping items I need to go over. If you have any questions throughout the webinar, there's a pane on the side of the GoToWebinar that you can submit your questions. We'll try to monitor that as best as we can throughout the presentation, but if there's any questions that we aren't able to get to, we will follow up personally via email. If you think of any questions after the presentation, you can drop those into the survey that's going to follow. There is a handout of the slide deck available to the right side in that same pane. You'll notice that a few of the slides, some of the text on the presentation may become small. So we recommend that you do actually pull a download of those slides and review. We will be offering CP credit for today's webinar. There'll be three polling questions throughout the presentation. Before we move through with those questions, we need at least 85% participation before we continue on. Post the presentation, you'll get a survey. You'll need to fill out the survey to receive credit. Another thing to note is we do disperse the certificates from a third party called SimpleCert. Please allow 5 to 7 business days for these to come to your inbox, and sometimes they do go to your junk mail, so you'll have to monitor that as well. I believe that's all the housekeeping items, so I will pass it off to Steve Snyder.
Thanks, Ryan. I appreciate that. I apologize for the short little delay. Had a little bit of a glitch in kicking this off. Actually, the truth is, timed myself and it was going to take about 57 minutes. So thought we'd tack that on the front. So anyway, I guess we'll get started. Bear with me. I got a little bit of a cold starting up, so I might be taking pauses to get a drink or something. But today, the focus is really going to be on how this new standard impacts the construction industry. I'm assuming most of you have heard about this for years and that it's not going to be a big deal. And the truth of the matter is that is pretty much true. It's going to be business as usual, but there are certain aspects of this standard that you need to be aware of. You need to assess whether it's going to be significant for your organization or not. And the best way to do that is to do a dry run, go through it, understand what these little nuances are, and calculate it out, see what it would have meant to the statements. And if you determine that they're not significant and your independent accountant, auditor, whatever level of attestation you have, whatever they agree with, you can just move forward. But you do have to go through that assessment. So with that, let's kick it off. Get to the first slide. As soon as I get the right button. There we go. All right, so today, these are our learning objectives. We're just going to do a short little overview of the standard. I got to imagine that most of you have already been through some sort of CPE session on this new standard, one way or the other, been bombarded with all the details of it at a very high level. But like I said, this was the intent here is to be very specific to a couple little nuances that as contractors you're going to see and have to deal with. We'll talk briefly about the 5 elements, and after that we're going to go through the considerations for contractors and then some steps for you to think about on the very end. And that little disclaimer there at the bottom, this is to provide general information. Implementation and assessment should be tailored to your needs. Okay. So let's kick this off with the first polling question. Now remember, you only need to get 3 of these. So if you're waiting now, you only need 2 more of them. So this is good. What has your company done so far regarding this new revenue recognition standard? I'll give you a few minutes as we wait for the results to come in. And since I didn't talk about too much yet, I really don't have a whole lot to talk about. But this new standard is probably one of the biggest standards that have hit our industry in a very long time. We're going to talk here shortly about what the difference is between this and maybe other standards that you've seen. So we are at, okay, so we still need a few yet. Okay, 59% currently working on determining the potential impact so far. All right, so those results, they're going to pop up here. Oh, okay, well, good. So what was that? 59% of everybody here had already started working through this, determining the potential. Very small part of you are already have it implemented. That's actually pretty low, but no worries. Hopefully after today, you'll have a better understanding as to the direction you gotta go. All right, next slide. All right, we're going to do a quick overview of the new standard, talk about what it's all about. So the core principle here is to recognize revenue, which depicts the transfer of the goods or services to customers in an amount that reflects the consideration of which the entity expects to be entitled to in exchange for those goods and services. This standard is principle-based, not rule-based. We've been very used to rule-based standards that have bright line tests. You had rules to follow. This one is a little different in that there's judgment that comes into play, some core questions you have to ask, and dependent upon how you answer those questions is how you will treat certain transactions. The purpose of this standard really was pretty much because of the world we live in today and globalization. We no longer work in those small little areas in which we live. More and more our banks, our bonding companies, those that are trying to benchmark and compare us are getting more information from around the world, really. So in an effort to standardize and make that information consistent, they issued this standard, which is more in line with IFRS, the international rules that everybody else in the world is following. So this is one of those that we're going to be following. Leases will be coming shortly. We have another year for those. And when should you start worrying about this? Well, it doesn't become effective until, for calendar year-end companies, it'll become effective January 1, 2019. So really, you should have been looking at this and thinking about it before. According to that last polling question, it looks like quite a few of you have already started thinking about what this is going to mean. If you haven't yet, not a big deal. It's not too late. You're lucky because our industry has the least impact, I believe, engineering, architects as well. Not as much of an impact moving forward, so you can catch up quick. So here's your 5-step process to the new revenue recognition standards. You've probably all have seen this in one diagram or another. Step 1 is identifying the contract. I think everybody on this call probably understands you don't do anything without a contract. So the identification process is pretty easy. Step 2, identify that performance obligation. So your performance obligations, really, you almost always have just one within your contracts. It should be pretty simple. The transaction price is on the contract, so that ties right into your obligation. Step 4, allocating that price. If you have multiple performance obligations, you have to allocate that price. And then step 5 is recognize your revenue. So a performance obligation. I bolded the word distinct. That is the key to this. It has to be identifiable. Gray areas make it difficult to determine that this performance obligation is distinct. An example is you're building a warehouse. That warehouse is delivered along with the landscaping, the parking lot. All of that is together. It's one deliverable. to your client. So that would all be considered one performance obligation. You'll notice through a few of these other slides, we're going to talk about the impact of multiple performance obligations and certain examples just to help clarify some of the rules. But for now, we're going to talk about what is distinct for a good or service. Can a customer benefit from the good or service either on its own or with other available resources? If not, it's not distinct. It is the promise to transfer the good or service from other goods and services in the contract. So do you have different goods and services within one contract, and can you discern between the two? If not, it's just one performance obligation. If you can tell the difference, you have two performance obligations. Overtime versus point in time. This is a concept. These are new terms that they're using. Essentially, this is percentage of completion, or you don't recognize any revenue until you've delivered that good or service, which is recognizing it at a point in time or the completed contract method. And most everybody on this call probably is using the percentage of completion, and that's what we're going to really be focusing on today. So the polling question number 2. Have you talked to your bank or bonding agent about the impact of this standard on your financial statements? So these are probably the main readers of everybody out there, that these industries, the bonding industries, the bank, they've heard about it, but do they really know what they're getting into? Do they really know what they're going to be seeing? They're not required to go through additional educational credits like a lot of you on the phone are. So as we go through this process leading up to when it comes into play, I would highly suggest that you're having that call with them. It's pretty important that they're on board with you, that if you do have changes in the way you're recognizing your revenue, that you should be talking to them ahead of time, because there can be some adjustments to equity, there could be fluctuations in trends. It's pretty important that they're all on board with that. So we've got 81% of the votes in, 40% of you talked to both, 23% of you aren't even sure really how to have that conversation. Well, hopefully after today, you'll have a better understanding about those nuances and what it will mean. And it's very possible you might even come out of this thinking, you know what, all I got to do is work through this a little bit, and on the back end, I'm going to probably determine that there's going to be an insignificant impact, and I don't have to change anything. That is possible. So here's what we're going to talk about today. Here's our considerations: combining contracts, modifications, which essentially are change orders, uninstalled materials, your fulfillment costs, which are mobilization and bonding costs, non-contributing costs to performance, and variable consideration. Okay, so we're going to kick it off with combining contracts. So where you got to think about this is any contracts you've entered into with the same customer at dates pretty close to one another. And what you need to consider is, do you have two separate contracts that potentially are going to deliver one objective? You just have it broken out into two contracts. And remember, the standard isn't recognizing revenue on the contract, but on the performance obligation. So you could have multiple contracts that you may need to combine to recognize revenue. So the fee on one contract, if the fee on one contract depends upon the fee or performance of another contract, you'll be required to combine those contracts. And the third bullet point there is if one or more of the promises in one contract is part of a performance obligation in the other contract. And if they're two different customers, you're not required to combine. So here's an example. We'll just walk through this one here pretty quick. You're going to design a building, signed on January 15th, total $500,000. Then you sign another contract on January 30th for the construction service portion of that for $8.5 million. But within that contract, you have a contingency written in there that the only way they get that 8.5 price is if they accept the design services contract. Without the acceptance of it, the contract price is $8.75 million. So there's a savings there for the owner by bringing you on board to do both pieces. So now your owner accepts it. You have contracts totaling $9 million. What's that look like? So here you go. So you got your first contract for $500,000 and the other one for $8.5 million. Total $9 million. But if they were done by themselves, they would be $9.25 million. So what you have to do with combining these contracts is you have to allocate the contract value proportionately among those contracts. And you can see, I got the calculation there to the right. You have to take your percentage of the standalone value and apply it to the signed contract amount. So the first contract actually is reduced in value and the second one is increased. And that's to kind of share those savings across the contracts. And then you would recognize revenue in that regards on both of them. So I added some software considerations here for you too. Not whether you've seen that or not yet, but you all work through a system, whether it be Viewpoint or any of the other major packages out there. Softwares will potentially be late to the game on these. So you might have to do some workarounds, work outside of your software until they do. I would suggest highly that you're reaching out to your vendors or your consultants and asking these questions. When you do these contracts like that, you'll have to recognize revenue on that allocated contract value, but you can't bill your customer on that. Your customer's expecting to be billed on $8.5 million and not that allocated value. So how do you bill that contract out of your system when you're recognizing revenue on a different contract amount? You'll end up with, differences at the end. And also, you have a contract, if you have contract loss. I'm sure none of you ever have that, but if you do, it's not measured at the individual contract level. It's looked at the total level. Combine it to calculate that. And for financial statement purposes, you will net your over/under billings between those two contracts and do it at the combined level. So contract modifications, these are your change orders. Contract mod exists when you have an agreement in writing, orally, or by other business practices to change, add, or eliminate enforceable rights or obligations of the parties under the contract. Sure, you all could read that. And even if not all the aspects of these changes have been agreed to or signed, but the obligation still exists and it's enforceable, you still have a contract that you have to apply these rules to. If the changes are not enforceable, it would not be included in the contract value, and you would just continue with respect to the original contract until everything's finalized. So there's 3 considerations on how to handle change orders. Treat it as part of the original contract. That step everybody on this call is probably used to. You just tack it onto the contract value, you increase your estimated costs, and you prospectively pick up any revenue through your percent complete. The second way is to treat it as a separate contract. Or, third way, terminate the original contract and create a new contract. And I have an example on that one, but let's go through all 3 here quickly. So the continuation, this first one. This is the one that everybody's used to, the way we've always done it. If the original contract, the goods and services that you're going to be delivering are not distinct from what that change order is asking you to do, you just tack it on top and you move on as you normally do, and revenue is recognized on a cumulative catch-up basis. Nothing new there. The second point, though, was if the modification adds promised goods or services that are distinct from other goods and services in the contract and increase the price of the contract by an amount that is reflecting the standalone selling price of those additional goods and services, then you have a separate contract. You wouldn't add that on to the pre-existing. For example, you're out and you're building a warehouse, and the owner just says, hey, I need this little additional small little building built, just 100 yards down the road. Can you guys do that as a change order to the original contract? Price, I'll pay you the full price, all that. That's what this is talking about. That change order would then be shown as a separate contract and treated as such. And the third one is the termination. Now this one's a little, we're going to go through this. I honestly don't know how often this may pertain to you, but I think it's important to be aware of it. I have another slide following with practical consideration on how to potentially treat the situation when it does arise to avoid going through this. But bear with me. We're going to talk through it. If anybody has any questions on that, please post them in the question area. And if we don't have a chance to get to it today, I will do a follow-up with you. So in this instance, the change order adds goods and services that are distinct, but does not reflect a standalone selling price. For instance, you have a shared, you're going to be able to save some money because you're already mobilized. So what you have to do is you have to reevaluate all the other modifications within the contract, look at what has previously been transferred, any goods and services that were distinct. So essentially we're talking about other performance obligations. And once you recognize and identify that, then you should be accounting for the existing contract as terminated and create a new contract with the remaining performance obligation plus the new change order. So as a result of this, there's no change to the revenue recognized to date. It's a clean cut. You don't go back, you look prospectively. So here's an example to kind of sum that up. I hope this works for you. So a contractor's been awarded a contract to build a new hospital, $250 million. After the contract started, construction's been going, hospital approves a mod for an additional pediatric wing to be built on the hospital property. Both the contractor and the hospital agree to this modification and with a total price of $270 million to be completed in 9 months. Had the general contractor done that change order as a separate contract, it would have been $21 million instead of the $20 million. So they both agreed, and they added $20 million onto the contract for the total of $270. Key factors in this: cost savings, that $1 million. You have a new performance obligation, which is the pediatric wing. And remember that combining contract role we talked about? Well, that's going to come into play here. There you go. Look at this. So here's what you have to do. You got to terminate the old contract. You create a new contract with any remaining value not recognized, along with a second contract for that new wing because it's distinct. And you reallocate the remaining value. So the top section here shows you the old contract. PO is not purchase order, but performance obligation. Making an assumption there were two performance obligations in there. They were 50-50 breakdown. Your first one is 100% complete. You're now working on your second one when this new wing comes into play. So that shows you up there what revenue has been recognized to date. Down below, you've now made the determination you have to terminate that old contract. So that performance obligation 2, you had $100 million remaining on that contract. So that starts off brand new, remaining value. It still carries the normal value of $100 million. But that third one, that change order that you got for $20 million, has a standalone value of $21 million. So if you remember from earlier when we did combining contract, this is the same calculation. So in the end, you're reallocating your contract price among the two, and moving forward, you're going to recognize revenue based on those values. And again, software considerations with billing and such. And we didn't even mention that, but think about what your project managers and how they're going to manage their projects. They're not necessarily looking at this value. They're probably going to want to stick to their original value with their original estimate. Throws a little bit of wrinkle into things. So practicality. So your change orders typically do not provide those distinct goods and services. It's more likely than not a rarity, but I've seen it happen. But because those goods and services are not distinct within the context of the contract, the pricing does not typically represent standalone, and you would just go on normal, like we mentioned before, step one. That said, if you do come across that situation, I think it's good to have a conversation with the owner of the project where he's just asking you to just tack it on to the existing contract, but consider doing a new contract altogether. If the timing is far enough between the beginning of both contracts, you're excluded from having to do the combining contract method, so that you can just treat this new modification as a brand new contract and no allocation of price is needed. I hope that makes sense. Should make life a little bit simpler. And as I mentioned, I think I mentioned it, but you always have your materiality to deal with. What's significant to the reader of the financial statements? If combining these contracts results in differences to your normal practice that are just not going to make a difference in the reader's decisions, you really don't have to do anything. But like I said, you still have to go through the exercise of calculating it to determine if it's significant or not. And with that, polling question number 3. Are your project managers going to be able to recognize and communicate the necessary information to the accounting department so that the information can be captured properly? Look at this as like a scale of 1 to 5 and see what you have. Give it a few minutes yet. Some of you out there think you have very good project managers. None of you have rock stars, though. All right. Okay. So we're at what? We're at about 35% of you feel like your project managers are going to do okay. 38% should be okay. It might need a little bit of coaxing. And, yeah, there's a few that need some help. Okay. So hopefully, internally, it might just be as easy as getting with your project managers and explaining these new rules. And at the end, I'll give you a kind of a bullet point list of some ideas, some processes to put in place to potentially help you with capturing the information you need to make the determination. So next, uninstalled materials. So this is one of those areas that a lot of contractors will buy a whole lot of materials up front, put them on the job, and cost it to the job. Under old GAAP, you would often try to determine whether they were unique, distinct, couldn't be used anywhere else. You would recognize that the rules were that you could recognize revenue up to the costs. Not everybody always did that. Usually easier just to drop it into your total costs, and it would really accelerate the recognition of revenue. So this new standard is slowing down that recognition. It's telling you that first, you got to follow the rules for GAAP as it relates to inventory. Are those materials inventoriable? Should they be in inventory? And I think what you'll see when we get through here that that's probably the path you'll want to go, depending upon what phase of the project that those materials will be installed. And you'll get a better idea of what I mean as we go through the example. But your materials, here's a couple bullet points about them. It's, your materials they'll arrive on the job and it's ahead of your being able to put them in. So using the cost-to-cost method, those costs incurred may not be proportionate to the progress of the job, like I was talking about. And you're sitting there off to the side, but your contract showing that cost-to-cost, you're 50% complete, but really you're 25% complete. So you've really accelerated that revenue. So what we want is you to consider whether those uninstalled materials should be inventory or if they should just be sitting there on the job site as uninstalled materials. And we're going to go through the process on how to recognize them here in a minute. So if the items are needed to complete a performance obligation, but they may not immediately transfer to the control of the customer, some of these costs will qualify as inventory, so there's no control. If the customer obtains control of the goods before installed, they would not be considered inventory, and they're still uninstalled materials, but they wouldn't be inventory. If the customer does obtain control with the materials not integrated into the overall project, these costs should be excluded from the measure of progress. You'll record those uninstalled materials at zero profit, so your costs will equal revenue. And what's the last one? So determination of whether the cost of uninstalled materials are significant is a judgment. So I put that in there because it always comes back to what's going to be more misleading, putting them in or recording them properly. What's that gross profit impact to the progress of the job? So whereas we don't have specific guidance as to what's significant, here's a little benchmark that I've read in some documentation. It says 15% or more of estimated contract costs really should be treated as uninstalled and have the following treatment. No, that's the next slide, sorry. So here's some determinations when looking at those uninstalled materials. Do you have the present right to payment for that asset? Does the customer have the legal title to that asset? The entity have able to transfer the physical possession of that asset? Customer has significant risks and rewards of ownership of that asset? And has the customer accepted that asset? So even though everything above is not a checklist and you don't have to meet all of those requirements, you are required to consider all the relevant facts and circumstances to determine whether control has transferred. Here's an example of what I'm talking about, what it looks like. So your existing contract, you have your uninstalled materials, they're in your total cost there. So your total cost to date, $300,000. You're recognizing $33,000 in gross profit at 16% complete. Under the new standard, you see that you scope out those uninstalled materials. So you really make this determination at the beginning of the materials. You should know how much of these materials are we going to be able to purchase ahead because you're able to get some price reductions or whatever. So you scope out those uninstalled materials. They drop into another line, $200,000, and you've got those costs in there that you incur that. You see how your contract revenue equals your cost. And what that does is that your progress on the remaining contract is only 6.25% complete. So you only recognize $12,500 of gross profit versus $33,000. And with the uninstalled materials, this is showing that they are fully installed at that point, or not fully installed. They're there, they're on the job, you can put them in as such. Software consideration for you. Will your software be able to break those out and recognize the revenue on just those costs and not include that in the overall percent complete calculation? So I'm thinking that most of them won't. I might be wrong. There might be some out there that can do it, but this might be a calculation done outside of the system. So here's some internal procedures to help with your project managers. If you put these in place, train the project managers to recognize these types of things, you can catch all of this before year end, before you have an audit, or if you haven't reviewed statements before your outside accountant comes in and looks at things. I won't read through all of them. You can see those. You can download the slides. The one I do want to bring attention to is the 5th bullet point, where you should have a procedure in place to segregate the estimated uninstalled materials from total costs and the transaction price. And that once this is done, it continues to be accounted for on the same basis for the life of the contract. So essentially what that means is that at no point will you recognize gross profit on those costs, even after they're 100% installed. That allocation of, or the progress of the contract cost to cost will be done excluding those uninstalled materials. And that's why I was saying it's probably best to inventory those materials if significant. That way, when you cost them to the job, you can pick up gross profit on them as a cost, as a job cost. You won't have to break out your uninstalled materials. All right, so contract fulfillment costs. These are the bonding and mobilization costs. So fulfillment costs are to be capitalized. And essentially, these are the upfront costs that are not part of delivering the performance obligation. These are the costs that go into before you get started actually performing work on that obligation. These costs are captured separately, and they're amortized over the life of the estimated life of the contract. And you'll amortize them based on a reasonable cost input. Are you going to do it cost to cost? You can do it over time, using time, dependent upon what they are and how you want to treat them. Just needs to be reasonable. And that last point there is that, as with any asset, you do need to consider them for impairment. So some examples of costs that do not meet the fulfillment costs and are expensed as incurred are your G&A costs, of course, unless they're chargeable to a customer. Wasted materials, labor, or other resources that are not reimbursed, and I'll talk about that a little bit later. Costs that relate to satisfied performance obligation or partially satisfied in the contract. Past performance that relate to past performance. For example, demobilization costs. So if you have mobilization costs, you probably have demobilization costs, but you can't really amortize them if you haven't incurred those costs yet. So they do not fall under fulfillment costs. And the 4th bullet point is costs for which an entity cannot distinguish whether the costs related to unsatisfied performance obligations or to satisfied performance obligations. All right, so here's an example. Top row there, of course, is under existing GAAP. You incurred your mobilization costs. That's all up in that costs incurred to date. And down below is the new way. So you'll see that you leave the contract amount as is. There's no contract value attached to the bonding costs or the mobilization costs. But you do break them out of your costs incurred to date into a separate line, and it goes against your gross profit. And as you can see on the far right, unamortized fulfillment costs. So as you incur them, you'll pick them up as contract costs on the job, and it's a 1-for-1 against the gross profit. So you'll just then come down to, instead of being 31% complete, you're really 28% complete on that project. You're not accelerating your gross profit by putting all those costs up front before you even start the job. So there's another software consideration for you. Can your software amortize those costs and roll them all up? And the big question there is how many of you are utilizing your software to do your WIP schedules? Or are you doing them outside on your own in Excel, in which case you can still run reports and do all of that. All right. Non-contributing costs to performance. So this is essentially right there, the bullet points: wasted materials, significant inefficiencies. Essentially what that is we're talking about rework. Did your guys mess something up? You had to go buy new materials, or the project manager is just not doing a very good job. You have a lot of inefficiencies. These types of costs are supposed to be excluded from your estimated costs and your cost to complete, so that your actual progress of the job is based on the original deliverable and that estimated cost to it, that any inefficiencies and all of that should not be part of accelerating revenue. That's really what this is doing. And that pretty much means that you would have to put a process in place to capture that rework, capture those inefficiencies in a separate task line item, and exclude that from the cost-to-cost calculation. Will your software be able to do that? I know you can open up a new phase or task within your software. Will it allow it to be excluded from the percent completion? Some considerations there. And if not, then at least have it captured separately so that you can pull it out and do your own adjustments outside of your system. So here's an example of what that looks like. Contractor enters into an arrangement to construct a building for $100,000, estimated cost of $80,000. At the period end, the contractor has incurred $40,000 in costs, but of the $40,000, $10,000 is wasted costs due to inefficiencies that are not included in the pricing of the contract. So then only 37.5% or 37.5% should have been recognized as revenue. And there you can see it below. So you have your top contract, which is how we normally would do it. We would just bump up those estimated costs for those additional costs, but they would also be in our costs incurred to date. Down below, it does increase your estimated cost, so it does reduce your gross profit, but your costs, their inefficiencies are not to be part of your progress. So they're pulled out of your percent complete calculation and are their own line. So that shows it as a contract loss as of that point, not to be accrued because you're still anticipating to make $20,000 on that contract, but your current contract date is going to be showing a loss. So here's an example of what a contract schedule could look like, with all of these considerations. As you can see, it's not as simple, but I threw this in here more of something for you to look at, something for you to go through as you maybe revisit the slides and are trying to figure out what impact this is going to have to your contract schedule. Most of you are, every single line is its own contract, but as you've seen through a lot of what we're talking about, you have breakout amounts. Whether you want to do that on a separate tab or a separate schedule and then roll it up into one line so that your schedules look neat, that's up to you. your bonding agent, more likely than not, your underwriters, they're going to be looking at that, and the math might not work on a cost to cost, so you'd have to supply that support and, just have the conversation with them. I would assume most banks aren't going to understand this yet. So with that, number 4, which area do you see having the most impact or change in your accounting procedures and reporting practices? Identifying your obligations, determining the transaction price and how to allocate it, fulfillment costs, mobilization, store materials, variable considerations. You don't expect any at all. That first bullet point, now that I'm reading it, was supposed to be contract modifications, but that's okay. We'll just leave it as is. Go ahead and we'll give you a minute or two. All right. So 50% of you are talking about the fulfillment costs, how to handle all that. That's kind of what I thought too. The contract modifications, which I didn't put up there, probably would have a nice impact as well. But for the most part, yeah, of everything I put up there, yeah, you're probably right, fulfillment costs. And with that, are we done? All right. So there you go, 84%, I think that's what it was, feel it's going to be the fulfillment costs. And I would agree. Or I said that wrong? Yeah, 49%. Yeah, sorry, it was 84 that I've answered. 49%, that's the majority. All right, so variable consideration. So I bullet pointed a few things up here. Variable consideration essentially is anything that's not included in the contract per se, but could add value or take away value from that contract, and it's variable. You really don't know for sure. And that makes up your claims, your pending change orders that are unpriced, incentives, penalty provisions, shared savings, price concessions, liquidating damages. I think most of you have seen all of these at one point in time, some more than others, depending on who you're working with, whether you see a lot of liquidating damages or not. The incentives, the shared savings are always nice, but I think the nature of the construction industry for most of you is probably to be conservative and not pick up any of those. This standard allows you to pick up revenue ahead of time with this. You notice that almost everything we talked about is deferring it further along. There are some areas in here where you can actually pick some up, dependent upon processes that you have in place. So for variable consideration, you have to evaluate whether to constrain amounts of variable consideration included in the price. So the objective of constraint is to include all variable consideration in the transaction price only to the extent it is probable that a significant revenue reversal will not occur. So essentially, when you determine that you can recognize those savings and that it won't reverse, and I'll talk a little bit further about that on another slide, but the objective of constraint is what you really have to follow. So the amount of the consideration included in the price should consider both the likelihood and magnitude of that reversal. So with penalties, refunds, discounts, claims, unapproved change orders, often you'll see unapproved change orders, work being done on unapproved change orders ahead of time. That's a common practice, whether anybody wants to admit it or not. The value could be explicit or implicit, doesn't matter. If you can put a value on there and you have something to support that through history or past history working with the customer, that works. And the contract price being cut at the end of the project, these are considerations. So you need to determine at the beginning of the contract by using all information available to you through historical, current forecast, to determine what that transaction price is. So if you have shared savings, and I think I'm going to talk about that. Let me not jump ahead. Before we get to the shared savings, so you have two methods for estimating that value of variable consideration. Most likely, all or nothing, where if you meet that performance obligation, you receive the incentive, but if not, you get nothing. You can include up to the max amount expected to be collected based on your prior experience and judgment. The other one is the expected value. What is the expected value? What is the expected amount in the range of values that you potentially can get? Your contractor will evaluate based on prior experience and judgment. As you can see, you have a lot of that prior experience and judgment. And as an auditor, that is where you probably want to do the best job you can. If you want to pick up this revenue, or if you're looking to defer revenue by showing penalties, you're going to have to support it with prior experience and a base judgment. So here you go, penalties. So if there are penalty clauses, the following are required. This is including your liquidating damages. Consideration must be estimated as part of the transaction price, so done at the very beginning. Factors to consider. What's the history of performing this type of work on time? Or are you always late getting that done because it's just an area that you don't specialize in? Is it within the control of the company to complete the work timely? So yeah, you have a history, and you're not dependent upon others to finish up on time, and then you don't have to include it if you historically are doing well and getting done on time. And will any uncertainty be resolved within a relatively short period of time? If the company has a history of incurring penalties, reduction of the contract price needs to be considered at the beginning of the contract. So as you do a profit fade analysis, you're looking at how your project managers are doing, and you have one particular one that seems to fade a lot, and most of the time it's because he's getting penalized for not getting the work done on time. If he is still employed with you, then you should be considering reducing that contract value at the inception. Incentives. So you have an incentive of $5 million for early completion. You need to determine whether you believe you're going to complete that contract early or not. If not, then don't include it in the contract value. But if you do, if you have a history of it, second bullet point there talks about past experience that you do. By all means, pick it up. Go ahead and put that in your contract price. And you can pick up that revenue over the life of the contract. But only if it's probable and a significant reversal of that revenue won't occur. But that's pretty much what bullet point 2 is telling you, is that you got past experience to support that decision. So we have 5 minutes left. Here are some other considerations. So, do you need U.S. GAAP-based financial statements? If you don't, you probably just wasted an hour, except maybe getting an hour worth of CPE credit if needed. For internal purposes, this is not necessary. This is GAAP only. If you're issuing statements to your bank, to an underwriter, or if your operational agreement requires a GAAP-based statement for the owners, then these definitely you do need to consider. Have the discussions with your bank and your underwriter as soon as possible. Find out what they know. And if you find that they're not too sure yet, it's not a bad idea to get your accountant involved, because they're going to be seeing different disclosures. They're going to be seeing potential equity adjustments, and you're going to want to be able to explain that, and they should know about it ahead of time. I think most of them in our industry are aware. They just don't know what they're going to see yet. We talked about, taking the contract, breaking it out for performance obligations, for revenue recognition. But what does your bonding agent expect to see on your schedule? Do they want to see contracts that are bonded together, presented together? How is that going to look on your schedule? Are you going to need to track information differently for tax purposes? I believe there's a new Rev Proc that allows you to elect to follow this new revenue recognition standard. I read an article on that a little while back that you can elect that in the year that you have to adopt this standard. Makes life just a little bit easier. Can your software handle these little things that we went through? I honestly think that software companies are going to be a little behind the 8 ball on that. Get on the phone with your consultants, find out what's going on. Will your bank or underwriter accept a qualified opinion from your CPA? So you always have the option to not make the election, which then requires your independent accountant or auditor to make or to qualify the opinion, but they still have to quantify the impact. Make sure that your bank or underwriter would accept that. You can also make sure your contract language is addressing any of these little things. You can tweak your language to get away from having to break out those uninstalled materials or combine contracts. And biggest suggestion here is create best practices and internal controls and processes. Get your project managers on board, educate them, and create processes to get information into your hands in the accounting department so that you can make the right decisions early on instead of doing a backtrack at the back end of the contract. And set up your software to capture that data the best you can. Start now. I would look at your contracts, group them together, and more likely than not, 90 to 95% of your contracts are probably similar, and none of this will even matter. But anything that's outside of the norm, you should take a look at. You have to document and support your conclusion that things aren't significant. Once you go through that exercise the first time, it's easy and you won't have to do as much work. Number 5, here's your last polling question. On a scale of 1 to 5, how comfortable are you that you are ready to implement? Maybe this didn't do it all for you today, but I hope that I was able to give you some insights as to what you're going to have to deal with. We have some confident people. 59%, I'll figure it out. That's awesome. And that's pretty much how everything happens. Once it comes out to play, it's the hardest thing to know what you really got to do, but things come together. So that's good. 61% are kind of, you'll figure it out. That's awesome. Reach out to your CPAs, your external CPAs. They'll be able to help you. So any questions? We have, well, actually we're at 3 o'clock. Yeah, let me go ahead and answer. I got a question here I can answer. So if you have a building contract and then a change order for a tenant fit out, would these have to be recognized as separate contracts? Does it make a difference if there is one substantial completion date versus 2 different target dates? So that's actually a good question. So who is going to be the recipient of that? So if you have the construction of the building and then you have a fit out, and that fit out, let me see, what does that say? So you get a change order for the fit out. I guess it depends. If you are building the building and you are significantly along the way, I think you could probably make the argument that that fit out is not a standalone performance obligation if the owner of the contract is the person requesting that fit out, that you can't deliver the fit out without the building, if that makes sense. So that could be a change order that is not distinct from your original contract. So I think that's probably the best way to go about that. There could always be nuances to that. It could be, the leaseor or the leasee is requesting the owner to throw that in on the lease, and the owner comes back and says, hey, you know, I have a fit out that I need added on, will you do that? At that point, really, they're doing it for the convenience of the tenant, and dependent upon that situation, I think you got to dig a little deeper. So I hope that answered that question. If not, please reach out directly to me, and I'm happy to talk through that a little bit more and talk about some more nuances to that. So for that wraps it up. I think that if there's any more questions, please feel free to send them in, and we'll get back to you and answer all of them. That just concludes the day. Hope everybody enjoyed and learned a little something. Bye.